Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about gamma hedging, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
Let me just say what the value of the XSP is. And I think that for someone learning this strategy, putting on an XSP trade is great because you're going to take very little risk and all of the elements are pretty much the same. There's really nothing different. It's just smaller and it doesn't have the same kind of granularity as a 4-digit index. It's only a 3-digit index, but it's still covering the same amount of market. Everything else is the same. The ratio of the commissions to the amount of profit you're going after is a little tighter. So it's a little bit more difficult to make money with it, but that's a good thing. From a training point of view, it's a great thing to use because if you can learn how to make any money on the XSP, you're doing great and you can do it on a consistent basis. That's one of the things it's good for in the context of our strategy. It's a great learning tool and it's not going to break your bank, even if you lose. The other good thing about it is that because it's so small compared to the SPX, 1/10 the size, you can effectively use it as a gamma hedge. And I know I've talked about this, but most people are like, oh, gamma hedge, what the hell does that mean? But it is a very effective fine-grained tool to be able to hedge your risk if your trade has moved right into the profit tent and you want to hedge it or prevent loss if you're afraid price might drop again from where it came. Let me show you. All right, so you see my trade here. Now, I wouldn't do it with price right here, but it's possible to do it right here because I've got almost $50 of profit, so that might be worth protecting. But let's say I moved right inside of the middle here and I want to protect it from going down. The only thing that's going to protect it is either I can get out or if I could find a way to change the shape of this profit curve to make it go like straight across. Now remember, gamma is the slope of that curve. So a gamma hedge would be getting rid of the slope of that curve. Does that make sense conceptually?
Oh, okay, yes.
And one way you could do it effectively, now it's impossible to do it just by putting on like another SPX trade. It's too powerful, just a single contract. But because the XSP is so small, it's not impossible. In fact, now if I were to change this from single portfolio to portfolio weighted, I could in effect add more trades with other assets and I can see their combined effect when I put them on. For instance, if I put on XSP, all right, so I can still see my SPX trade in the context of an XSP world. See the bottom change to XSP scale, but that's my trade still there. So I could put on an XSP trade and I can see the effect of both of them at the same time. So in other words, what would happen if I put on a put that had a strike of say 496 or 497 so that if price goes down, I win on that trade. If I did that with an SPX, it would just totally distort this entire strategy and it wouldn't be practical. But with an XSP, because it's so small, I could do that. So I'm going to put on a long put with a strike price of 496. All right, so you see how that affected it? Now let me take it off.
So you put it on at the same spot?
I put it on with a strike of 496. I can put it on with 495 as well. Let's see how it works at 495. It'll cost me a lot less. And then I can put this on. Now see how it changed the shape of the curve?
Yeah.
Flattened it. That is exactly what I just said. That is a gamma hedge. It is taking the slope of that curve and removing it. That's how you hedge it. You're hedging the risk, which is associated with the slope of that curve, because that's what causes the sensitivity of price to price movement going down. I remove that sensitivity by adding this, and now there's no sensitivity. Now, of course, there's still going to be premium decay and everything, but at least for the time being, if price moves down, I'm not going to lose anything.
And you bought that put, right?
Yeah, I didn't actually buy it. I'm just putting it on as
I know you didn't actually do it, but that's what you would do. You wouldn't sell one, you'd buy one, right?
Yeah, you can see it's a buy. It's a long put.
So if you're hedging, you're putting on the XSP at there, and at the cost of it though, are you hedging against losses? Are you trying to preserve your profit?
So what I'm hedging for, let's say that I expected price to just drop, right? I won't lose any money.
Yeah.
However, over time, I will lose money because there's a difference between this and where the at expiration profit line is. So over time, over the course of a day, if I'm in this too long, that hedge is going to be lost to premium decay. But for the time being, it is hedging me for the next hour or two, maybe.
Yeah, I can see that. I understand that. What kind of threw me a little bit is the cost of that second trade. And how does that work out in your profit plan?
That's not what I'm trying to do. I was asked, what good is the XSP? And I gave you two reasons.
Right.
Thanks for watching guys, I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.